1. Set clear financial goals. Determine your investment objectives, timeline, and risk tolerance before getting started. 2. Diversify your portfolio. Spread your investments across different asset classes, stocks, bonds, real estate, etc., and industries to manage risk and potentially maximize returns. 3. Invest for the long term. Investing is a marathon, not a sprint. Avoid constantly buying and selling based on short-term market fluctuations and focus on long-term growth. 4. Understand risk and reward. Higher potential returns typically come with higher levels of risk. Assess your risk tolerance and make investment decisions accordingly. 5. Do your research. Before investing in any stock or asset, thoroughly research the company, its financials, and industry trends. Stay updated on news and developments that may impact your investments. 6. Consider index funds or ETFs. These funds can provide diversified exposure to a market or sector and often have lower fees compared to actively managed funds. 7. Stay disciplined. Create an investment plan and stick to it. Avoid making emotional decisions based on market hysteria or short-term trends. 8. Rebalance your portfolio. Regularly review your portfolio to realign it with your target allocation. This involves selling assets that have appreciated significantly and buying assets that have underperformed to maintain your desired risk and reward profile. 9. Don't try to time the market. Timing the market consistently is extremely difficult, if not impossible. Instead, focus on investing consistently over time to benefit from the power of compounding. 10. Learn from mistakes. Investing involves risks, and it's natural to make mistakes. Learn from your mistakes, analyze what went wrong, and adjust your investment strategy accordingly.